welcome to what we hope will be a long-running series called Another Financial Podcast. I know, Mark and I, we both spend a lot of time watching podcasts on, in the finance space and during our time, and said, what does the world need? I think another financial podcast.
Yeah, we'll throw our hat in the ring here and see if it works. See if anybody out there wants to listen to us.
Absolutely. So the idea is we'll come to the table with, a financial planning concept, a market commentary or insight perhaps, once a month or as frequently as things unfold, and see what works. And today's episode we thought we'd kick off with is, a little bit of a controversial topic on both fronts, I think. On the financial planning space, asset location does not matter. And then looking at the market commentary where, the Sp500, the U.S. market right now, is a five-car pileup. Too concentrated, and we'll delve more into that after a quick introduction. My name is Ryan Archambault. I'm a chartered financial analyst, as well as a chartered investment manager working for Wellington Altus Private Wealth up here in sunny Kelowna, BC. And Mark, you want to introduce yourself as well?
Yeah, thanks. Yeah, Mark McGrath. I'm a certified financial planner, chartered investment manager as well, like Ryan, and a chartered life underwriter as well. So I'm coming in from also sunny Squamish, BC, so just north of Vancouver.
Great. And we go back kind of loosely a couple years here anyways, across a couple firms, now both with Wellington Altus, but prior to that with a firm specializing more so in physicians and medical practitioners. But in joining Wellington Altus, where our core concepts are, being independent, entrepreneurial, unconstrained. I think we just both interpreted unconstrained to mean we can nerd out collectively on the internet, right? Hopefully for the pleasure of our viewers.
Yeah, hopefully. Yeah, no, I mean, for me, it basically just meant the opportunity to sort of, run our own practice.
And it's been a long road of saying, hey, what can we do different? And why I think we've got such good synergies is that, my background has been mostly on the study of, the capital markets. I think it's fair to say you specialize more so on the financial planning front. And, yep. But, underneath it all, really, we have this goals-based framework and approach to wealth management, right? Where it's, we're trying to take a look at, what are we ultimately trying to accomplish here? The portfolio should be a reflection of that, and every piece and every security within, has its reason that is tied to your financial plan. Mm-hmm. But, where, of course, we were here to talk about why asset location does not matter. You sent me this paper, I want to say about a week ago, and I'll admit, Mark, I was hurt. I didn't, this threw something across the windshield for myself that I did not like, because I was, coming through the industry with the fact that a taxable or a corporate account should not be treated the same way as an RSP, should not be treated the same way as a TFSA. But you've kind of broken some ground on that. Can you outline and provide some background on what the paper highlighted?
Yeah. So this is there's a couple papers, and there's a number of papers on the topic, but the one that Ryan's speaking to is there's two. They're both written by Ben Felix, who's a portfolio manager at PWL Capital out in Ottawa. So quick overview: the conventional wisdom on asset location is basically that certain types of investment income are less or more tax efficient than others, and then certain type of investment accounts have different tax treatment or advantages. And so, to Ryan's point, the conventional wisdom is that you should hold your tax efficient investments in the least tax efficient account, right? So you're generally going to hold anything that generates capital gains or Canadian dividends in non-registered or corporate accounts, anything that generates interest or, say, rental income in your RSPs or TFSAs, right? And intuitively, that makes sense. It sounds good, and I think most of us as advisors kind of understood that. So this paper was really interesting because it kind of took a totally different perspective. So there's two papers. The first one was in 2017, and it basically tried to analyze, well, what is the benefit? Like, what is the after-tax benefit of an optimal asset location? So if you do this correctly, what's the uptake? What's the upside?
And I think the key of what you just said there is looking at it on a post-tax basis, right? Because most of where the original theory came from was, okay, before tax, here's how we're going to allocate. We'll put your more aggressive stuff in either a taxable or TFSA, your more conservative or income-generating stuff in an RSP. But I think where this paper threw a wrench in the gears is let's put this additional lens over top and say, what does that actually look like afterwards? Because the government's got a lot more of their hands in the RSP income than it
Yeah.
does the other two vehicles.
Yeah, that's just right. So that's exactly it. So there was kind of two ideas here. One is quantify what's the actual benefit, right? So there's a number of papers on this. The benefit it looks like is somewhere between 20 to 30 basis points after tax when done optimally, right? So there is some merit to the idea that you should do this, right? Um, but the problem is that doesn't show up all the time, right? So it's not every single time. We don't know exactly what an optimal asset allocation is until we kind of get to the end and look back, right? But maybe we should look at kind of optimizing this. So that was kind of the first paper. It quantified what an optimal asset allocation was, and then the 2019 paper was really fascinating because it viewed it through a different lens. So to your point, your RSPs, let's just assume top tax bracket for a moment, right? The government owns half your RSPs in that scenario, but they don't own half your taxable accounts, your holding company or your non-registered account, right? So if you take an investor with a 60-40 portfolio, 60% stocks, 40% bonds, right?
Just a classic
Again,
balance.
conventional, yeah, classic balance portfolio, and assume that they've got $1 million, right? So they've got 600,000 of stocks, 400,000 of bonds, right? So conventional theory would say all the bonds in the RSP, so $400,000 bond RSP portfolio, all bonds, 600,000 of stocks, all in the taxable account, right? Well, when you look at that on a post-tax basis, as I said, the government owns half your RSP, so really you only own after tax $200,000 of bonds, not 400, right? So assuming no tax on the stocks, right? Because we're not talking about future capital gains, we're just talking about drawing out the income from the paying the tax. Now you've got an $800,000 portfolio, 600,000 of which is stocks, 200,000 of which is bonds. That's actually a 75% equity or stock portfolio after tax, right? So you thought it was a 60-40 on a post-tax basis, it's 75-25, right? The paper basically outlined that the benefit of asset location in that circumstance is actually that you've got a higher allocation to stocks. So more of the after-tax return is coming from the fact that you're actually holding more stocks than you thought you were, right? And
Yeah,
kind of to
you're
prove
a whole
this,
bunch more aggressive, right? I mean, that
yeah,
was the big eye opener for me. Is holy geez, if we are actually dividing up the same strategy among different accounts, it's really the RSP here that is the main consideration. If you run that
yeah,
too conservative, and that's supposed to be the source of all your safety, but the
yeah,
government owns half of that,
yeah,
you're actually overexposed. Your risk tolerance is probably disconnected from the conversations
yeah.
that we've had with our clients.
Totally. And you may not notice it through the volatility of your portfolio because you're looking at your portfolio on a pre-tax basis, right? You're seeing the 60-40, you're seeing the volatility. But again, the government kind of owns half of that volatility as well, right? So the way he kind of proved this was he went, okay, if it's a 75-25 portfolio after tax, let's take a step back and allocate both accounts, the RSP and the taxable account, the same, but to a 75-25 portfolio. So your taxable account is 75% stocks, 25% bonds, and so is your RSP, right? And because taxes will reduce both asset classes on a proportional basis, after tax, you're still holding a 75-25 portfolio, right? So what was the outcome? Higher net after tax returns in that scenario than the 60-40 portfolio that was optimized from the traditional sense, right? And the last point I'll make about this is that the more you analyze your portfolio, the more you try to optimize things, the more you introduce behavioral issues and behavioral biases that can undo a lot of what the so-called benefit is of that asset location, right? I mean, the more you analyze your portfolio, the more decisions you have to make, the higher probability that you're going to introduce some sort of behavioral bias like market timing, trying to get ahead of a downturn or something like that. So the way I'm thinking about asset location going forward for myself and for clients is it's the last frontier of portfolio optimization, right? Like first, make sure your asset allocation is correct, that it's in line with your risk tolerance and your goals and your required return in order to meet your future financial objectives. Dial that in first, right? Once you've got that done, look at fees, right? Like obviously trying to keep your fees low. If you need exposure to a particular asset class, find the fund that does that well for the lowest fee, right? Depending on what your strategy is.
Of course, yeah.
And then make sure your own behavior is in check, right? I mean, if you're the type of person that likes to tinker with your portfolio, like asset location is not your problem right now. So unless you've got those three things really dialed in, I don't even think it's really worth looking at. And if you do, it's still kind of up for debate whether there's going to actually add any value to you after tax.
Oh. And
Yeah,
second part, looking more so then towards the market commentary. I
yeah,
posted on this week, and this is not a
saw
new
that. Yeah,
revelation. This has been with us for a little bit here. Just this rising concentration, particularly, we'll even include Canada in this, but just more predominantly in the United States, where you have, Apple, Microsoft, Amazon, Tesla, and Google, right? That is five stocks. That is 23% of the U.S. market by size. And of course, that used to be Facebook included last year, but Tesla obviously had explosive growth. Facebook rebranded to Meta, which was not friendly to their market cap, so we kind of shoved them off of the list there as well. Because I don't know about you, we traditionally went back to that mantra of we're going to buy low and sell high. That's what we're looking for. Right? This is the disconnect, right? That's where the profit margins exist. What's happened is that through the advent of these ETFs or exchange traded funds, you're buying a company simply because they are the largest in a particular segment. And for those uninitiated, the ETFs are just a way to buy into the market as it stands today. So if Microsoft is the largest company, it will be the largest weighting that you buy into, and so forth for Apple, all the rest that follow.
Yeah. Now you're specifically talking about index ETFs. Like we should just clarify because there
index
are
ETFs, absolutely. And then that has been the area of most rapid adoption, right? If you're going to actually try and keep your costs low, then you're going to say, you know what, I don't believe that investment managers have the ability to outperform. I'm just going to throw my money passively into the market, and that market has exploded. Since the financial crisis, it has taken off.
Yeah.
So when you get to this level, a natural kind of economic cycle, this harkens back to what Dalio is talking about market cycles and recognizing patterns, and Howard Marks and all the rest. When we're at this level, and investors are not being overly selective about the companies in which they're choosing to invest, there's that potential for misappropriation and investing into companies that don't necessarily offer the best potential for you. And what are we going to discover about the earnings expectations of a Microsoft or Apple or Google or whatever have you that is this large mega cap that the guys at the institutional firms at Vanguard or the larger players have not already priced into what they're trading at right now?
Sure. Yeah.
And I was careful about broaching this one with you because I know I use ETFs in my portfolios. I know you use them as well too. But you know what? That's another risk factor because when the big five names are all tech stocks, what's more detrimental to the U.S. market as a whole right now? Is it truly a recession or an economic pullback? Or would it just be, one antitrust challenge where the government steps in and says, you know what, you've got too much of a corner on the market in this area of tech, and we need to make sure that there's other competitors. And it's where, it's just adding that extra layer of risk management towards what we're dealing with right now.
Yeah, it's interesting because as you know, I am primarily an index investor for myself and for a lot of my clients, right? Not always exclusively, but I am a big fan of index funds. And this, you're right. There's a concentration risk, certainly right now, especially in the tech space, right? It'd be interesting to look back in time at various points and see what that concentration risk was in indexes historically, and was it always in one sector like technology, right?
Well, there was. This is, we're going to throw some more Howard Marks in here, but he had written quite frequently about the rise of the Nifty 50, right? And this was back in 1968, and it was, the top 50 stocks within the U.S. market that could do no wrong. They were considered the sure thing, and no price was too high for what you were willing to pay for a share of their
What was it back then? Do you know?
And these were the names of IBM. You're looking at Kodak. You're looking at Xerox. It was companies that by 1972, you were sitting in a 75% plus loss position. Just because valuations got too high, and we come back to the fact that a great company can still be a terrible investment if you pay the wrong price for it.
At the wrong price, yeah.
So we've seen that. We saw that again in the 2000, the first original .com telecom bubble there. And you know what? There just has not been a period of time where the top 5 names, or even the top 10 will give you, have been the same 10 years forward.
Oh yeah.
And right now, for sure, your .com, your telecom 2.0. But if you go back 10 years, we're looking at 2010. That was all oil in China, right? Yeah. 2000, absolutely. .com, telecom. The names are all different. Microsoft is the only layer of overlap there. 1990, the mantra was just buy Japan. Because all of a sudden, holy geez, yes, dwindling population, but these guys can automate. And when you can automate, you don't even need to be based in Japan. How closely tied is Toyota to the economy of Japan? right? 1980, you're still back to that oil and gas. And, the top minds in the United States said, we're going to run out of oil reserves by the time we hit 2020. You didn't anticipate the shale revolution. You didn't anticipate, the push towards clean and renewable energy. But it will be a different set of 10 names that are the largest companies in the world in 10 years time, and how do we say that our best investment opportunities exist in these top 5 stocks right now? I argue you just can't.
No, but we all have this recency bias where if you look at Google, Amazon, Microsoft, Apple, they can do no wrong, and over the recent history, it was an amazing investment, maybe some of the best investments you could have made in your life, but we only know that in hindsight, right? And so picking those today and assuming they're going to continue, it's like Vancouver housing, right? It just can't go down apparently. So it's always going to be a good investment. Yeah, until it's not, right? So getting ahead of that, I think, is the challenge for a lot of investors.
And that's the thing, particularly in the tech space, because, right now, digital photography, great industry, great place to be, but it's all GoPro and DJI now. Kodak is nowhere on the radar, right? So who's going to be the name of tomorrow? ETFs are a good way to, make sure you pick up on some of that exposure as they're on their way up. But you know what? Traditionally, this is the era where active management does have a little bit of an edge.
We'll see, I guess, for some managers, right? You just got to be amongst the top, right? Consistently over long periods of time. Yeah, that's fascinating.
I think we've covered off, for one, our financial planning concept for the day. Asset location, not as much of a factor as previously understood or previously taught in more of the traditional schools of thought. And as well, beware of some concentration risk rising in the U.S. market. And that's the idea. 2 quick hits and send everybody on their merry way. So until next time, Mark, thanks so much for your time.
Yeah, likewise, Ryan. Good to chat with you. Do it again.